Welcome back to LutaMarkets, your ultimate destination for mastering powerful Forex trading strategies. In today's video, I'll show you a simple yet highly effective strategy that combines supply and demand zones, trendline break and retest. This method gives you sniper entries with precision and minimal risk. If you've been struggling to time your trades, stay tuned, because this strategy could be a game changer for you. Let's dive right in. Let's start with the basics, supply and demand zones. A supply zone forms when sellers overpower buyers, causing prices to drop. Think of it like a ceiling. Whenever price reaches this area, selling pressure increases, and the market often reverses downward. A demand zone, on the other hand, forms when buyers take control and push prices higher. It's like a floor. Price tends to bounce back up when it reaches this zone. To identify these zones, look for areas where price makes a strong move away. Pay attention to areas where price consolidates briefly before that big movement. This indicates institutional orders. Quick tip: supply and demand zones are strongest when they have not been retested multiple times, because fresh zones often hold more power. Now that we understand supply and demand, let's define the trend line. A trend line is a diagonal line connecting two or more swing highs or swing lows, showing the direction of the trend. It acts as support during an uptrend, as buyers protect that line. Resistance during a downtrend, as sellers defend it. Here's what makes a valid trend line. It must connect at least 2 points, preferably 3 or more. The more touches, the stronger the trend line. The line should not be forced, follow the natural swing highs and lows. When price breaks a trend line, it signals a potential trend reversal. But don't jump in yet, always wait for a retest of the broken trend line before taking your entry. This is where we combine it with supply and demand zones for the best results. Now let's combine everything and look at this powerful strategy step by step. Step 1. Identify the trend line. To start, we need to identify the trend line in the market. A trend line is a diagonal line drawn to connect a series of price swings, showing the market's overall direction. In an uptrend, the trend line connects the swing lows, the lowest points where price temporarily reverses upward. The more times a trend line has been touched, the stronger and more reliable it becomes. Key rule: for a valid trend line, you need at least 2 or more touches on the line. Example in this chart. Here, we can clearly see an upward trend line that connects multiple swing lows. Each time the price touches this line, it bounces back, confirming that the market is in an uptrend. The upward trend line signals that buyers are in control, and the price is moving higher. Step 2. Spot the supply zone or demand zone. Now that we've established the trend line, we look for a supply zone. A supply zone is an area where sellers have aggressively entered the market, pushing the price down. It's typically found near a market high or a resistance level. Pushpin: what to look for in a supply zone. A significant, strong downward movement caused by sellers. The area where price previously stalled and reversed downward. The stronger and faster the price drops from the zone, the more powerful the supply zone becomes. Example in this chart. Near the top of the market, we see price stall and then make a sharp, downward move. This tells us that sellers have stepped in, creating a supply zone. This zone becomes the area where we anticipate price will reverse again if it comes back to test it. Step 3. Break of the trend line. The next step is crucial. It's where we begin to spot a shift in market momentum. What happens? The price breaks below the upward trend line. This is a signal that the current uptrend might be weakening or reversing. When price breaks the trend line, it means buyers are losing control and sellers are starting to take over. Bullseye: why is this important? The break of the trend line is the first clue of a potential reversal. However, we don't jump into a trade just yet. We wait for confirmation. Example in this chart. Notice how price clearly breaks below the upward trend line. This signals that the uptrend has been violated, and the market is shifting direction. At this stage, we're preparing for a potential sell trade, but we wait for the price to retest. Step 4. Retest plus intersection equals perfect entry. This step is where the magic happens. After the trendline breaks, price often comes back to retest the trendline it just broke. In this case, something powerful happens. Price retests the broken trendline. At the same time, price also comes back to the supply zone where sellers previously stepped in. Pushpin: why is this intersection important? The intersection of the trendline retest and the supply zone creates a high probability entry point for a sell trade. This is because the broken trendline now acts as a resistance level, where sellers step in. The supply zone reinforces the selling pressure. Bullseye entry confirmation. Once price retests the intersection, Look for bearish signals like a rejection candle, bearish engulfing pattern, or strong downward momentum. This combination gives you confidence to enter a sell trade with a tight stop loss above the supply zone and a favorable risk-to-reward ratio. Example in this chart. Look closely at how price breaks the upward trend line and then moves back up to retest. At the same point, price touches the supply zone. This intersection is a perfect sell entry because it aligns two strong signals, the broken trendline resistance and the selling pressure at the supply zone. This combination of factors, a broken trendline, retest, and supply zone, gives us a high probability trade setup. Why? Because sellers are defending the supply zone, and the broken trendline now acts as resistance. Price respects the intersection and moves sharply downward, giving us a profitable trade. Quick tips for success. Always confirm entries with strong price action signals like pin bars, engulfing candles, or rejection wicks. Use a stop loss just beyond the supply or demand zone to protect your capital. Combine this strategy with higher time frames, like 4H or daily, for even more accurate setups. If you found this strategy helpful, don't forget to like the video, subscribe to LutaMarkets, and hit the notification bell so you never miss a powerful trading setup. But wait, there's more. I'll now show you a real-time video example of how to combine supply zones with a trendline break and retest for precise entries. So keep watching until the end and see this strategy in action. Thanks for watching, and I'll see you in the next video. Happy trading.